Welcome to the Mountain Path, the world of finance. This is Ravichandran. This session we will discuss all about volatility. And we'll discuss what is volatility. We'll also discuss what is historical volatility. What are the shortcomings of historical volatility? We'll discuss implied volatility and how does implied volatility can be used to trade on options. How do we calculate implied volatility using Black-Scholes option pricing model? Let's quickly go into today's discussion. So what is volatility? Volatility is a statistical measure of the dispersion of returns for a given security or a market index. So in most cases, the higher the volatility, the higher the risk of the security. So volatility can be calculated and by measuring the standard deviation, and for a specific time, so volatility is equal to sigma into square root of that time. So the historical volatility is nothing but an annualized standard deviation of the past security prices. Historical volatility is a realized volatility and describe the past movement of the underlying security. There are some limitations to the historical volatility. Historical volatility gives about the past performance. The past performance may not accurately predict the future price volatility. Non-stationarity, that market conditions and dynamics change over the times. So historical volatility may not capture the changing nature of the financial markets. It's a short-term focus. Historical volatility is typically calculated over a specific period, such as could be daily, weekly, or a monthly. So that means it may not reflect the long-term behavior of the financial instrument. Volatility clustering. Financial markets often exhibit high and low volatility. So historical volatility may fail to capture the clustering effect, leading to underestimation or overestimation of the future volatility. Assumption of normal distribution. So historical volatility assumes that the price return to a normal distribution. However, the financial markets may often experience fat-tailed or skewed distribution, so thereby leading to inaccuracy in volatility estimates. It also provides limited information as historical volatility considers price data, does not incorporate certain other factors like market events, market sentiments, changes in fundamental factors. Let's quickly, so how do you calculate historical volatility? If you download the Nifty index for 1 year, if you calculate the log normal returns, daily log normal returns, you can calculate the daily standard deviation multiplied by the number of trading days, and we will calculate the annual standard deviation. It comes to 12.60. You can see that the historical volatility, even for a limited period, is not absolutely normal. So it does not have a normal distribution, perfect normal distribution. Let's quickly go into what is the implied volatility. As per John C. Hull book, the implied volatility is a volatility that makes Black-Scholes option pricing and equal to the market price. That means we are equating the market price in the Black-Scholes option pricing model to derive implied volatility. Implied volatility is not volatility. Basically, it measures the demand and supply of a particular option, whether it's a call option or a put option, and based on the higher the implied volatility, and the option price could go up in future, and the lower the implied volatility, that means the option price could come down. So implied volatility is an estimate of future variability of the asset underlying the option contract. So the Black-Scholes option pricing model is used to derive implied volatility. One of the important assumptions, Black-Scholes option, the underlying asset follows a geometric Brownian motion with a constant drift and volatility. Summarizing, implied volatility represents a fair value of volatility based on the market's expectation for movement over a specific. That means based on the expectation of the underlying price, underlying security, the implied volatility gives a kind of a prediction, a fair value of the volatility, how the stock will behave. Now, normally we calculate option price in Black-Scholes option pricing model by having the current stock price, strike price, the expiry, the interest rate, as well as the historical volatility. We derive the call option or the put option price. But in implied volatility, we reverse engineering by actually equating, we give the call option put option price given by the market as one of the input. So we can use goal seek or solver in Excel, or we can use any other software to derive an implied volatility. So the estimate of an implied volatility is as good as the inputs used to obtain it. The best implied volatility estimates are derived from at the money options and over heavily traded securities. So historical versus implied volatility, that the shortcomings of historical volatility and always and have some problems in the Black-Scholes option pricing model. And so now let's go into a simple example. How do you derive an implied volatility? Let's take a simple example. Let's say the current call option price is 15, the strike price is 13, and the risk-free rate of interest is 5%. The time to expiration is 3 months, 0.25. Let's assume some volatility of 15%. We'll derive the call option price by calculating D1, D2, norms list of D1, norms list of D2, and we'll calculate, it comes as 2.17. Now, using the same data, and let's calculate and implied volatility using a simple goal seek. Let's go into and a goal seek function. Since the market option premium is given as 2.5, so that means the option market premium is 2.5. So let's take the input as 2.5 by changing the variable and the volatility. So we can calculate. So now we are able to derive the implied volatility as 40% if you input the call option price as 2.5 in the Black-Scholes option pricing model. So option prices drive implied volatility. It's not implied volatility that drive option prices. Please understand, it's the option prices that drive implied volatility. Now, so let's go into the further discussions on and implied volatility and how to estimate standard deviation and the potential stock price movement in the immediate future. How do we estimate the probability of a stock price movement using implied volatility? Thereby it will help us to trade on options effectively. So implied volatility is forward looking. That means it is an annual implied movement of the underlying. If the implied volatility is 20%, that means the underlying price can swing 20% either side. So we can also calculate the probability of the price of the underlying reaching a given mark during a specific time. If we know the time to expiration, and we can estimate the standard deviation and with the use of implied volatility. So how do you calculate one standard deviation of a stock price movement? So the formula is current stock price into annual implied volatility into square root of days to expiry, number of days to expiry divided by 365, and that will give you one standard deviation. Let's take a quick example to calculate. Say the current stock price is 50, and let's take the period is 1 year 365 days, and like that the implied volatility is 20%. So the expected stock price movement using the calculations is the expected movement is current 50 into implied volatility is 20% into square root of and 365 divided by 365. So that will give you 10. So that means the expected movement is 10, and that means we can see that and the stock can go and minus 10 or plus 10. So that means the range will be 40 to 60. Now using this data, we can also say, so this represents a 68.2%, since it is a one standard deviation. So the one standard deviation represents the range is between 40 to 60 and the next 1 year. So you can increase the implied volatility. You can see that if you increase the implied volatility from 20% to 40%, the range also increases. Okay, and if you decrease the implied volatility, and we can see the distribution narrows down. So that's a very important thing that we should have a clear understanding. So now, using implied volatility, and we are able to estimate, and for one standard deviation, what could be the stock price movement, what could be the range and the probability. If we say 68.2% probability, the stock will be between 40 to 60. That means there is a 1 minus 68.2%, that is a 31.8% probability the stock will be outside the range. So that isn't. Let's take one more example. Let's say the current stock price is 100. Let's assume 1 year period. Annualized implied volatility is 20%. So the expected movement of the stock, that is a 20. That means it 20 plus or minus a 20, that is 100 plus or minus 20. The stock will be between 80 to 20 with a probability of 68.2%. That means there is a 31.8 probability the stock will be outside this range. Now, so a standard deviation of the probability of one standard deviation and actually says 68.2% outcomes in the distribution of the occurrence of the and on current implied volatility. Two standard deviation, if you multiply two standard deviation, that means 95.4% outcome we can estimate. Three standard deviation will give you roughly 98.7% of the outcome of the distribution. So now if you put it in a summarizing in a table for the same example, and one standard deviation with implied 20% and implied volatility, and then the stock price will be 80 to 120 and with a and 68.2% probability. And so with the two standard deviation with the same implied volatility, now we can see the stock price range, the distribution and range increases, widens up 60 to 140 with a 95% probability. And three standard deviation, and you can see that implied volatility, that is standard deviation into 3 into and 20%, that will give you a range of 40 to 160 with a 99.7% probability. So with the one standard deviation that gives a low implied volatility, suggesting the range of expected price will be narrow. The higher the implied volatility, the standard deviation range increases. The 2 and 3 standard deviation will result in wider range, or that might happen. So the implied volatility moves up, the option price will go up. The implied volatility moves down, the option price will come down. So we can simply see, you can with this example, so the call option and put option price for various implied volatility we can see that, and it is always going up. So the option price that denotes the demand and supply, and for the underlying expected price movements, that will increase implied volatility, that will also increase the call option price. If an option is bought when the implied volatility is high, and that means if the implied volatility is going to be high, if you buy it when you have implied volatility low level, that means you are buying an option premium at a low price. When the implied volatility goes up, that means you can make a profit by selling the option. Let's say that currently the implied volatility is very high, the option is premium is high. You sell the option, then you expect the stock to cool down, and the implied volatility will also go down. Thereby what happened? Then you can actually buy back the option. So implied volatility can be used and in stock options trading. So low implied volatility environment tells us the market is not expecting the stock price to move from the current price. A higher volatility implied volatility tells us the market is expecting large movements from the stock price. So implied volatility always gives a forward looking, a kind of an estimate how the price will move up. It is also dynamic. A sudden change in the environment, a sudden expected news that can affect the underlying can change the implied volatility suddenly also. So high implied volatility, there is a higher chance of the large price movements expected. In contrast, a low implied volatility, that the market price movements to be relatively harmless. Generally implied volatility at the money options are lower than for in the money or out of the money. So basically implied volatility varies with the change in the supply demand equilibrium. So it's dynamic. So you can use implied volatility in option trading. That means a lower implied volatility will result in a low option premium for the same strike price. A higher implied volatility in future will result in a higher option premium for the same strike price. So how the implied volatility will also behave. So implied volatility indicates the underlying price movement in future. At the same time, an implied volatility also can dynamically change and certain situations. So based on the expected implied volatility, option trading can be done to take and make position long or short position on call or option. So the expected implied volatility is more important option trading. So this ends the session. Hope you find the session useful. Thank you very much for listening.